Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at WeRide.
If you find our talks useful, please consider subscribe, like, and comment underneath. We've got a genuinely fascinating setup for you today.
Yeah, it's one of the more striking contradictions in the market right now.
But before we get into all that, we just want to mention StockOracle. We've got a special 14-day trial link below in the description.
Right, and just as a reminder, StockOracle is an AI-aided stock research platform. It is not financial advice, or a trading signal service.
Yeah, or real-time market data.
Yeah.
Just a great tool to help structure your own research. And that link is an affiliate link, meaning the channel may earn a commission at no extra cost to you.
Exactly. And please remember that StockOracle's AI insights and valuation estimates, well, they can be incomplete or wrong, so important facts should always be verified.
Absolutely. Always do your own diligence. So let's talk about WeRide because, the hook here is just wild.
It really is.
Picture this. You have a company operating fully driverless taxis right now, like on the actual streets of Dubai.
Real cars, no humans behind the wheel.
Right. And the revenue in their flagship product segment just exploded by over 800% in a single year.
Year over year, which is a staggering number.
By all logic, Wall Street should be just throwing money at them. But instead, their stock is bleeding out near 52-week lows.
Down over 53% from its peak.
Yeah. So today, we're trying to figure out what happens when this hyper-growth business reality collides with a completely depressed market valuation.
Because for anyone looking to build wealth in the autonomous vehicle space, this poses the ultimate question.
Exactly. Is this a classic value trap, or is it a deep value opportunity hiding in plain sight?
Right, because when you're dealing with a sector as capital-intensive as autonomous driving, rapid growth, and intense risk, well, they always share the same passenger seat.
So let's look under the hood of the fundamentals. Because if you just look at the stock chart for the last year, it's just been a slow bleed.
Yeah, it's tough to look at.
But despite that, the actual business generated $16.5 million in the first quarter of 2026.
Which is roughly 114.1 million RMB.
Right. And for the whole company, that represents a 57.6% year-over-year increase, which is solid. But the number that really forces you to pay attention is the Robotaxi segment specifically.
That's where the 800% comes in.
Yeah, it grew by 836.7%.
Yeah.
To me, that signals they are moving past the theoretical testing phase.
Right. They're not just running a pilot program in a geofenced suburb anymore. They are moving into actual commercialization.
Putting cars on the road and getting paid for it.
Which is the hardest barrier to cross in this industry. Translating a science project into a monetized scaling fleet is a completely different game.
And what stands out to me isn't just that top-line revenue growth. It's the margins.
Yeah, their gross profit increased by nearly 56% year over year.
Hitting $5.7 million. Giving them a gross profit margin of 34.7%.
Which, when you think about a business that requires physical vehicles, hardware sensors, complex logistics.
Maintaining a 35% margin at this early stage is pretty impressive.
It's a strong indicator of pricing power.
I hear that, but if you scroll down to the bottom line, the picture gets incredibly murky.
And the operating loss.
Yeah, they're sitting on an operating loss of $62.5 million for the quarter. And negative free cash flow.
Which is massive.
It's like building a rocket.
Yeah.
Right. You have to burn a terrifying amount of fuel to escape gravity.
But once you're in orbit, the margins are beautiful.
Right. But they have this safety net, a cash runway of $902.4 million.
As of March 2026, yeah.
But I have to push back on how secure that safety net actually is. If you're burning over $60 million every single quarter from operations alone, $900 million can vanish much faster than people realize.
Especially if they hit regulatory roadblocks.
Exactly. Or technical delays.
The burn rate is undeniably high, but evaluating hypergrowth requires looking at the trajectory of that burn, not just the absolute number. We have to look at operating leverage.
Okay, break that down for us.
So in this same quarter where revenue grew by nearly 58%, that $62.5 million operating loss actually narrowed by 1.2% compared to the previous year.
Okay, so the core cost of running the business shrank slightly, even as they pushed revenue way up.
Exactly. And the crucial detail is that they didn't do this by cutting corners on research and development.
Right, because you could just slash R&D to make the balance sheet look better for one quarter.
But they didn't. Their R&D spending actually increased by 11.5% during that period.
Wow. Okay.
Operating leverage means the incremental cost of generating each new dollar of revenue is decreasing. The foundational stuff, the core software mapping overhead, is largely paid for.
So as they add more robotaxis, more of that revenue actually flows through the business.
Right, rather than being eaten up by fixed costs. So having over $900 million in cash means they are shielded from near-term financing risks. They don't need to dilute shareholders tomorrow just to keep the lights on.
But they're buying time with that $900 million. And time doesn't automatically equal a competitive advantage.
No, it doesn't.
To justify that burn, they need a tech moat that competitors can't just copy in 6 months. So what is that R&D money actually buying them?
It's buying them their proprietary WRD 3.0 technology.
And the big selling point there is multi-chip compatibility.
Exactly. They're running this software across NVIDIA, Qualcomm, and CEngine platforms.
Which, in a world where semiconductor supply chains are constantly bottlenecked, being hardware agnostic seems like a massive structural advantage.
It's huge for strategic flexibility. If geopolitics restricts access to a specific NVIDIA chip,
Or Qualcomm just raises their prices.
right, WeRide isn't held hostage by a single supplier. They can pivot. But while that's a great defensive strategy, their actual offensive advantage is their data ecosystem.
Level 4 autonomous data.
Yeah, fully driverless, no steering wheel robotaxis. They are taking the learnings from those operations and feeding them down into mass production L2++ solutions.
Let's clarify L2++ for a second. That's the
Yeah.
advanced driver assistance you'd get in a regular consumer car,
Yeah.
right?
Right. You're still driving, but the car helps with steering and highway cruising.
And if an L2 system encounters a chaotic intersection, it's designed to disengage. It hands control back to you, the human.
And because it hands control back, the AI never actually learns how to navigate the dangerous moments.
It only learns how to drive when the weather is perfect and the road is straight.
Exactly. But a level 4 vehicle has no human to fall back on. It has to solve the problem to survive.
So the data it generates is just on a completely different tier.
We call it survival data. And WeRide is actively mining this L4 survival data to train the consumer-grade software they sell to auto manufacturers.
Which connects to their recent launch of WITT, which is a physical AI cognitive foundation model.
Right, we're all used to language models right now.
But a language model hallucinating just means you get a weird email.
Exactly.
If a physical AI hallucinates, a 4,000-pound object going 40 miles an hour makes a catastrophic error.
Physical AI is about transforming chaotic real-world data momentum, weather, friction into trusted learning signals. You can't just code that in a lab simulation.
You need real-world validation data.
And they are getting it, testing in Germany, France, Japan.
And pushing aggressively into the Middle East. They're targeting 1,200 robotaxis across Abu Dhabi, Dubai, and Riyadh by 2027.
With Dubai already operational.
Okay, so with all this fundamental tech built out and these global deployments, what are the upcoming catalysts? What's going to actually move this stock?
The major imminent catalyst is their Q2 and first half 2026 earnings on August 12th.
Right before the U.S. market opens.
The market is going to put that Q1 report under a microscope. They need to see if that 836% robotaxi surge was a one-off spike.
Like just an initial fleet delivery in Dubai.
Exactly, or if it's sustained commercial momentum. And they need to see that operating loss continue to narrow.
But there's also a macro catalyst here, right? Because they have a beta of 1.752.
Which means you're strapping yourself into a roller coaster.
Yeah, a beta of 1 is the market average. So 1.75 means WeRide is 75% more volatile than the broader market.
It's highly reactive to macroeconomic trends, especially U.S.-China trade relations.
Because if tariff disputes or semiconductor restrictions flare up, WeRide takes a disproportionate hit.
Regardless of how flawlessly their cars drive in Dubai. But conversely, if those tensions soften, the stock could launch upward.
Okay, but even with those catalysts on the horizon, if we look at the technicals right now, the chart is genuinely ugly.
It is.
We're looking at a trading price around $5.82. Teasing that key technical support level of $5.
Just a prolonged downtrend.
Yeah, 13-week return is negative 22%. The 26-week is down nearly 33%. And the 52-week is down over 36%.
There's a tiny 5-day uptick of about 3%, but zooming out, it's a steep slide.
And the trading volume is totally asleep. It's trading at 0.57 times its 3-month average.
Which tells us there's no momentum breakout. But it also hints that people aren't aggressively panic selling either, they're just kind of ignoring it.
Which feeds right into the market sentiment. Because the analyst community is deeply bullish.
Yeah, their 12-month average price target suggests over 150% upside.
But if Wall Street sees 150% upside, why is the volume dead? And why have there been zero insider buys or sells in the last 90 days?
It's a textbook show me market.
Are investors just waiting to see who blinks first?
Basically, look at the insider in action. If you're an executive and your stock drops 50% and you know the company's failing, you sell.
Right, you get out.
The fact that nobody is selling suggests quiet confidence.
Yes.
But to your point, they aren't buying the dip either.
Right. If I know there's 150% upside, I'm buying shares at $5.
It means they might feel secure in their vested shares, but they aren't pounding the table with fresh cash. The broader market sees the 800% growth, but they also see a massive pile of risk.
Which brings us to the bear case. We have to look at the risks keeping people away.
And the most glaring one is the profitability.
The trailing 12-month net margin is negative 228.41%.
Which will immediately deter purely quantitative value investors.
I mean, for every dollar they bring in, they are spending vastly more just to operate.
And the fear is they deplete that $900 million cash pile before revenues truly catch up, forcing a highly dilutive capital raise near the bottom.
And we can't ignore the competition. You've got Alphabet's Waymo and Baidu well ahead in the Robotaxi space.
Infinite war chests.
Exactly. Waymo is backed by Google. It feels like WeRide is this incredibly agile middleweight boxer, but they're trapped in the ring with two 800-pound gorillas.
It's an existential threat. But as an investor, you weigh that risk against the price you're paying today.
Priced in risk.
Exactly. The stock is down 36% over the last year, and if you look at their price-to-book ratio, it sits at 1.78.
And for anyone listening, book value is essentially what would be left over if you shut the business down, pay the debts, and liquidated the cars and IP.
Right. So a price-to-book of 1.78 means the market is pricing WeRide very close to its literal liquidation value.
The market has already baked in a worst-case scenario.
So while competing with Alphabet is terrifying, the downside might be highly limited at this $5 price tag.
Creating a favorable risk-reward setup. Because if they fail, you're buying near the bottom anyway. But if those Middle East partnerships scale, the upside is explosive.
Which brings us to the final verdict, synthesizing the analyst targets, the L4 data loop, the cash burn. The analysis assigns WeRide a bullish score of 7.
Okay, a bullish score of 7. So how do you play that?
It frames it as a classic high-risk, hyper-growth, deep value setup. It sets up two potential horizons for you.
One being a short-term swing trade into those August 12 earnings, betting the commercial momentum held up.
Or you look at it as a 12-month hold. You ignore the daily macro volatility, trust the $900 million safety net, and give the global expansion time to mature.
It definitely requires a strong stomach for risk, but the underlying tech is undeniable. And again, this talk is an exploration of the data and sentiment, not financial advice.
It's a profound case study in how markets struggle to price disruptive tech.
It really is.
Yeah.
And I want to leave you with one final provocative thought to mull over. We've spent this entire time evaluating WeRide as a taxi company, comparing them to Uber or Waymo.
Right.
But if WITT, their physical AI model, actually works at scale, what if physical AI becomes the global standard for how machines interact with the real world?
Oh, wow.
Maybe 10 years from now, we realize they were actually building the underlying data infrastructure for the entire physical world, and robotaxis were just the data collection mechanism.
If the end game is a universal operating system for physical AI, then valuing them based on taxi fares is missing the forest for the trees.
It completely reframes how you look at a $5 stock price and a $60 million cash burn. They're laying down tracks in a very chaotic frontier.
Absolutely.
Well, that wraps up today's analysis. If you found this useful, please remember to subscribe, like, and comment underneath.
And don't forget to check out the special 14-day trial link for StockOracle down in the description.
Yep. It's an AI-aided stock research platform to help you frame your own strategies. Thanks for joining us, and we'll see you next time on Smart Wealth with Joshua.